Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Covered Calls and Short Puts. And you know, today is a very special day in the history of Wall Street. I don't know if you realize that, but there is a brand new type of options contract that just started trading today. I don't know if the word has gotten out yet. We're going to make sure the word does get out. We're going to talk about this new type of options contract, and we're going to actually trade it today. So really looking forward to this. It's still very rare. Only 9 securities out there offer this type of option. So we'll talk about what it is. We're going to actually be placing that trade. We'll follow up on existing trades as well. So a lot to cover. Before we get to any of that, though, let me first of all say hello to everybody who's chatting in. Great to see all the familiar names. Hello there, Mighty Mouse and Hamlet and Moonlight, JDLMI, Tony, Mark, SB, welcome. Who is that? Ron, great to see you as well. Everybody else, thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you happen to be here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, well, those recordings are a great way to watch these webcasts. But if you would like to be here in these live streams, this is a Monday webcast series. We kick things off promptly at 2 Eastern time. Now, as a treat for my live stream audience members, my good friend Barb Armstrong is joining us in the chats. Barb's going to be keeping an eye on any questions that come in that I'm not able to get to. Barb's just going to help pick up the slack for me there. Thanks for having my back there, Barb. Barb and I have worked together now for years and years and years, so she brings a lot of experience to this discussion. Barb and I would also like to issue an invitation to everybody watching to follow us on social media. You can follow Barb and me on X. So you can find Barb there at Barb Armstrong CS. You can find me on X at Cameron May CS. But as of a couple of months ago, you can also follow me on LinkedIn. Just go to linkedin.com/in and then /Cameron May CS. But let's get into this very exciting topic today. Brand new type of contract being introduced. So maybe they're just starting out with a few. I expect maybe this will expand into the future for additional securities. But as we do this, just be aware that risk is real. So this is important information. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views, and investing involves risks, including the loss of principal. And finally, any investment decision you make in your self-directed account is solely your responsibility. JDLMI says, I never let you down. It's going to be a good one. I think it will be. So let's set an agenda for today's discussion. First thing that we're going to do, as always, is take a look at our existing positions. Then we'll take a quick peek at the markets. And finally, we're going to have our discussion. Today's discussion is about this new type of options contract, which is a Monday and Wednesday expiration contract. That's just never been available, American-style contracts on individual equities before. So this is exciting news for those who have had that frustration where we have to maybe wait a week longer for a contract expiration than we might have preferred, or even just a few days. It can be vital. So this can be a big step forward for some investors and some traders. But we're going to talk about those new Monday and Wednesday contracts, which securities offer them. We're actually going to use it to plan and place a new trade in our portfolio. It's actually going to be an extension of an existing position. But all of that in this one discussion. So let's go right to the thinkorswim desktop, look at our 7 current positions, and it's actually our 8th one that's going to lead us to the discussion that we're going to have. So let's pop through these 7 just quickly. First of all, we have Apple. This is a put contract. We were assigned at the 265 strike. So we purchased 100 shares from a put that we previously sold. Now, we'd previously sold 2 series of puts. So we sold some December 265 puts. Those just expired for a 277 profit. Sold the 16th of January 265 puts, or just one of them. That was assigned. So we were assigned up here at 265. The stock is down here, but rallying. So we have a decision to make. We own these shares now. What do we do with these shares? Shall we just sell them. If a trader thinks that the stock is likely to fall, well, we're sitting on a bit of a loss, a few $100. We have what, $547 in realized gains. This is paper money, of course, setting commissions aside. About 550 bucks in profits that have been realized, but the shares are underwater to the tune of 968-ish. So total maybe down about $400. Do we think this is likely to recover? Here's another consideration. There's an earnings announcement in just a few trading days. That's right around the corner. So what should we do with this? I'm going to throw that out for real consideration for my attendees. If this were in your paper money account, what might you be doing with this? So some might think lower highs, lower lows doesn't look good. Others might look at, well, we got a nice bounce today, up 3% in a single trading session so far. But we do have the earnings. I think what we'll do, we're gonna keep this one. We were going to consider selling a covered call if we were assigned. We are assigned, but with this earnings right around the corner, I'm not going to put a cap on this one. Let's just keep that. Move on to ABBV. With ABBV, we have 200 shares, sold 2 calls the 30th of January contracts, so those just have a few days remaining on those. We paid $227 on the stock. It's at $219. This one's also a bit underwater, although not as much. Let's see. Let's go to our ABBV position. ABBV, am I thinking ahead? No, that's right. That's right. Yeah, we're not as much down as we might have thought on this because we already have a realized gain on some calls that have previously been closed. So these are the calls that we sold recently. That's lowered our break even down here to 223.42. We're just below that break even at this point. Looking to see if we can continue a rally. We were going to consider closing if the support breaks. Look where we are right now. Now, we didn't have our webcast last week because that was a holiday. So it's been a couple of weeks. During those 2 weeks, we broke that support and then we've rallied right back up to it. We're kind of at a tilting point again, maybe for this trader. So what should we do? It'd be nice if we could just sit here, see how the day plays out. There's still a couple of hours of trading. We don't have that luxury. So once again, there's an earnings announcement around the corner. These contracts that we've sold expire before that announcement. I think we're going to come back to this with this sitting right at support. It says consider closing if support breaks. It broke, but then sort of patched itself, and we're right there at that support level. I'm going to leave that one on again. Moving on to our Amazon position. In this case, we've sold the 20th of February 235 puts, 2 of those contracts. We'd prefer here for the stock to remain above 235 as we push toward the 20th of February, and we're at 239 right now. So here's what Amazon is looking like. With Amazon, here's what we've done already. We previously sold some puts for 370. We closed one out for a 303 profit. We closed a second out the last time we convened for a 365 profit. And we sold a new put at that 235 strike. So that's right here. And our break even for all of these premiums that we've collected from 235 is going to be down here at 226.06. So you can see we're solidly above the overall trade series break even. And I think we're just going to let this one go. Yep. Mark says, let's hold on to that one as well. I agree, Mark. Let's move on. Obviously, just because we choose to hold doesn't mean we did the right thing. That's something that we can only see in the rearview mirror. So we'll come back in future weeks and we'll follow up on these and discuss the management and whether our decisions have turned out to be the right ones or not. Microsoft sold a 380 put. We'd like the stock to be above 380. Well, it is. Handsomely above 380. It's at 472. We must be really profitable. No, we actually sold this for $23. It's worth $27. How is it possible, being so far out of the money, that this contract has gained value? It's a put. Well, that's because it was way out of the money when we sold that put. It's just less out of the money than it was when we first sold it. So going back to that, this is our Microsoft position. Here's Microsoft. This is when we sold that put. The preference being, we just want to see one rally sometime in the next few months. Any good rally here, hopefully, we'll get this up to where the put is significantly below $23 in value. Maybe we can close that out. We just haven't seen that rally yet. So time has been working in our favor, but price has not. So we're still well above our strike price. That's way down here, but we've teased pretty close, quite a bit closer. But this is starting to rally again. There is that earnings announcement. Boy, that could make things interesting. I like to talk about interesting things. Let's hold and see how it goes. Okay, so Microsoft, moving on to our Nvidia position. What happened here with Nvidia? Well, we just own 100 shares of stock. Here's the history of Nvidia. So we bought 100 shares at 183.71, sold some calls, closed those for a profit. Sold some more calls, those expired for a profit. Sold some more calls, these expired since we last talked for another $1.93 profit. Our break even is now down here at 174.95. We were considering exiting this one if this horizontal support level broke. It hasn't. What I might do with more recent support being a little higher, let's do this. Let's activate this drawing and move our support level up and maybe look at exiting now if this support level breaks. Let's activate that drawing. Let's try to pop this over here. So that's going to be the new plan. We're kind of looking to exit even if we're just right down toward that break-even level. Oh, and Mark says with Nvidia, the calls expired worthless twice. Do we want to consider selling calls again? Well, actually, Mark, let me see. I actually had that exact thing to do in my session notes. Yep. Yeah, trader. Now, of course, we might just say, well, we're above break even. So overall, this trade is making money. Let me see what it's showing here on our position statement. Notice it says we're up $313. Well, that's how the shares are doing. We would add to that the realized gains on that series of 3 different contracts that we've already made profits on. So we're much more profitable on this than is currently displayed. And these others where we've taken a setback, we're not set back as far as that would appear. But Nvidia, yeah, let's sell a call. Let's go to the charts. And there is an earnings announcement coming up. That's after the February contracts. Let's see what we can get for a February contract. Maybe sell it up here above this resistance again for a trader who's looking to try to minimize the likelihood of assignment. An approach that some technicians take is to sell above recent price ceilings with the hope that we just stay below that price ceiling. Now, would it be disastrous for this position if we were to go above and get assigned, get called out? Not necessarily. That would be a forced profitable exit, but it can put a cap on the upside potential of the trade. I think that's what we're going to do today. Let's maybe sell. Should we just look at the, I wonder if we could do this one again. What is that? The 195? I wonder what we could get. Haven't looked. So we're going to discover this together. If we were to sell around this 195 area, let's go see what we can get for that. Go to our trade tab. Let's look at the 20th of February. 195 is about a 35 delta. For those of you who look at delta, there's about a 35% probability that this contract expires in the money and we get called away or called out. About a 65% probability that we're still below. Now, delta can also tell us how much a contract might make or lose on a $1 move in the stock. But yeah, that probability is another potential usage of delta. And that looks like we might be able to bring in on the order of maybe 375. Now, we only have 100 shares, so we need to make sure that we only sell one contract if we want this to be a true covered call position. So let's click on that 195 bid price. That's going to bring up an order to sell 10 contracts. We just need one. And how about we set that 375 as the limit? That's going to be the minimum that we're willing to accept. Maybe the order doesn't fill. We're just saying it needs to be at least 375. Let's click confirm and send. Selling that one Nvidia 20th of February 195 call, trying for 375. There is a commission to be paid, which chips away at that credit a little bit. Right there, 374.35 would be the net if that's what we fill for, if we do fill. This will tell us there's a maximum loss infinite loss potential. That would be true if this were a naked call. This is a covered call on an existing stock position. So let's send that order off, and I'm gonna let that work. As we go up here to our working orders, we're saying we'll accept 375. It's trading about 377 and a half. That was 375 to 380, mid price 377 and a half. We'll see if this fills. Might need to come back to that. But a couple more positions. We have, there it is. Okay, sold for 375. Great. So you put that on the chart. I'm just going to put a text note. If you wonder where all these words come from, this is where they come from. I kind of pick a convenient position here. Let's click right there. And we sold the 20th of February. That was the 195 call for, and it was 375, right? Yep, that's what I do. And I just change the colors. Make that red to indicate that we sold to initiate a position. And we'll make this line red also to indicate that we have a short strike right there. Okay, does the 375 premium collected appear on the statement immediately? It does, Deepak. It's credited to the account immediately. That doesn't mean that we have a profit, obviously, because there is a huge condition attached to that 375 that was paid to us. We get the deposit into our portfolio, but in exchange, now someone has the right through the 20th of February to buy our shares for 195. And if we ever choose to exit that call, if we buy it back, it might cost us more than 375 to do that. So it's not a profit yet. It could turn out to be a loss. We'll see. But we're done with that position. Let's see, with Philip Morris, we've sold a put. Look at the value of this put. We sold it for $1.77. It's worth 12 cents, $12.50. Only one contract. Let's go to the charts. And you might think, oh, this is a no-brainer. Let's just get out. There we go. Take a moment for my drawings to load. But we sold that put right there, hoping to stay above 155. Got a little bit below it, but boy, it's been a nice rally since then. So it is way out of the money. And there's only a few days left in these contracts. So, and we collected already. Well, we have 177. We might be able to exit for maybe, let's say 12 cents. That would leave us, if we are, with $1.65 realized gain with no additional risk to the trade, if we're able to fill that order. Should the trader do it? Well, there are pros and cons. There's not a whole lot left on the table at this point, literally $12. But that's a very high probability 12 bucks if we just leave this thing alone. As long as the stock is above 155, the most likely scenario, very rare exceptions, is that we just expire worthless, and there's our $12. On the other hand, if in the next couple of days this thing collapses all the way down, maybe we get put those shares. And if the trader didn't want those shares, maybe that's what they want to do. But in this case, I'm actually going to leave it. Eric, this is going to make you nervous, right? Eric says, take it. I'm not gonna. I'm going to leave that because I want to see what happens and talk about it next week, but realize there are pros and cons to that decision that I just made. But I'm just going for the very high probability outcome here. I would guess that probability is somewhere in the order of 95%. That's a guess. I could check it actually. So it's the 155 put on Philip Morris. If I go to the trade tab and I look at the 155 put, and it's not the 20th of February, scroll up here to our position. What's the delta on this? 3. That means there's a 97% probability that the contract just expires worthless. And we make another 12 and a half bucks, plus no commission to watch this thing expire worthless. So maybe we sidestep that as well. Eric says you won't be sleeping all week. Yeah, yeah. If this is keeping the trader up at night, maybe they just do close it out. But the risk of losing some paper money doesn't keep me up at night, although I would suggest you be as realistic with these trades as possible. One more, and then we're going to have that discussion about these new contracts. Okay, so we have Visa. We own 100 shares. What's happened here? Bought the shares for $354.54, but there is no current call sold against this because this has happened. If you look at Visa, We bought the shares right there. Ooh, that is painful. We sold some calls at 357.5, and those expired for a 213 profit. Then we sold some more calls at 352.5, and those expired. We actually had a stop, so we were looking at the stock staying above right here. We had a stop to get us out if the price happened to fall below that, and it did right here, but that was just after these contracts expired, and that stop order expired with those contracts, so it was not triggered. And then we met, I believe it was right here. I believe it was on this day, as it looked like the stock was starting to rally back up to our support level. So we decided to hang on to the shares, and they collapsed. That's a possibility. So what should we do now? Here's my question for you. The stock has fallen again. We are definitely underwater on this. Nothing we can do about that. That's history. We have to deal with today. So what do we do with these shares that we now own? Should we just exit those shares before this earnings can make things even worse? Or maybe those earnings make it better? Or since it's holding above support, maybe we just hang on to that. Maybe we hang on to it. What do you think? User we3im1pq1s says, for this strategy, do we need to ensure we have 100 shares in our account first? Yes. So we discuss covered calls in this webcast series. So if that's the strategy being implemented, the trader would either need to own the shares or buy them simultaneously with the same order in which they're selling the call. Yep. JDLMI says, V is a tough one. It is. Do we know how this earnings announcement is going to go? No. This could go a long way to repairing things. I don't know if it's going to get us back to our break even, but it might help. Here's another consideration. You might think, well, why don't we just sell a call? Premiums are probably inflated going into this earnings announcement. That's probably true, but our break even is way up here. There's probably not much premium that's at those contracts that are $30 out of the money. So if we're trying to sell a call that doesn't obligate us to sell the shares at less than break even, that might be tough. I think with this one, okay, I'm getting a vote from Chuck to say hang on. Eric's saying how about we just put a stop in place below support? I think I'm going to go with that, Eric. Let's put a stop in here. If there's a big gap down, one of the risks of stop orders, not a guarantee that we'll sell at a specific price, but what if we put a stop down here? Let's not be too tolerant. How about we just go down below? What's the lowest point on this candle? It got down to $318 on the nose. So how about we go 317.50? So if we see the lowest low in the last 8 months, we're waving the white flag. Okay. So RB Tech Trader saying maybe we sell a put instead. That would be adding. Okay, that would actually be adding a bullish position to a bullish position. Or if we're selling the stock, it's just replacing a bullish position with a bullish position. It still comes down to, can the stock recover or not, right? So how about we do that? Let's put in that stop at 317.5. Let's go to our monitor tab. I'm going to right click on that position and create a closing order with a stop. And we're going to put that just below those 8-month lows, 317.5. And we'll make that good till canceled. But of course, as we do, remember, a stop is not a guarantee that we'll sell at 317.5. It's just the trigger price. In any case, there's no commission on this trade, but there can be on some types of trades if it gets filled. So let's send this order off. And that's it for current positions, except there's one more. And this one's going to lead us to that discussion. So just to build the anticipation, I'm going to hit the pause button on that, because I just noticed that Barb has reposted this. Thank you, Barb. There's a survey link in the chat window for the live attendees. So if you're here in our live stream audience, if you do me this favor, click on that survey link in the chat window right now. And then just fill out the survey at the end of the webcast when you give me some honest feedback. It's a really short survey. There are only 2 questions. And then there's a comments box and a suggestion box. So if you take the time to fill that out, as quick as it is, it's still important. And I take the time to read through all that data. I read through the comments. That stuff gets sent right to me. So it's not a wasted effort. Thanks for doing that. But Kelly says, why is there no commission on some types of trades? It's just the way it is nowadays, Kelly, which is to be applauded, because those of us who've been around in these arenas for a while can remember how much it was back in the day. I remember back in when I was a full service retail broker, I remember just doing a stock trade for somebody. It cost them over $1,200 in commissions. It took me 10 seconds. Yeah. That's nice that same trade nowadays is $0. Now that was with a different firm, but yeah, commissions have really dropped. So CC Martyr says, why don't you use stop limit orders more often? It's not a bad question. I probably just do it out of convenience. It takes a little while to explain it every time, but there are pros and cons to stop limit order. So maybe what I'll do, let me sort of add that to my future webcast ideas file to go through that, because it would seem intuitively to be an improvement on a traditional stop order, but it really depends on what the stock does. So, Kelly, you were a stockbroker back in the 80s, so different now. Yup, very different. Yeah, the trade that I was talking about was back in the mid-late 90s. Yep. Okay, so let's get to the mystery stock that's going to lead to our discussion, and that is Alphabet. Alphabet was a position in this portfolio, but something happened to it. Let me bring it up here. So here's Alphabet. We bought some shares way back here, and we've owned those shares now for about a year. Bought the shares for $199.15. We started selling calls on those recently in this webcast series. So we collected and retained a profit of $275. We collected a premium and realized a profit of $277 on some December calls. And then we sold some January calls for $290, collected that premium, but those calls were assigned. And those shares have been sold. Now they were actually sold for $325. We purchased those for $199. So according to my math, that's $125.85 profit per share on that stock position. So that was a great trade. But we no longer have a position in Alphabet, and I intend today to establish a new one. So let's go ahead and let's plan for that. Maybe our trader looks at this and says, well, I'm out of my previous trade, which turned out great. Let's get into a new one, possibly on the evidence of the stock moving higher. But there's this little obstacle right there, possibly. Some traders do not like owning stock or doing covered calls or even selling short puts over an earnings announcement. Others are like, well, it's just part of life. Every 3 months, if I'm trying to avoid that happening every 3 months, it gives me a narrow window in which to execute all of my positions. And maybe if their theory is that it all is sort of a wash at the end of the day, some will go against us, some will go for us, and we do this long enough, it tends to have less and less a sort of a diminishing impact. Maybe if that's their look, that's their outlook, they're fine doing these trades through earnings. But here's what I'm going to do. Let's buy some stock shares and sell a covered call that actually expires before that earnings. Well, we might not have been able to do this last week because today's Monday. Maybe there'd be a contract that we could sell that expires on Friday. But actually nowadays, let's see. So this conference call or that announcement, I think that's next Wednesday. That's next Wednesday. Well, there is a new type of options contract. It's only available on 9 total securities. It's this type of contract started trading today, and it's a Monday, Wednesday, weekly contract. So what I mean by that is these are weekly contracts, but instead of expiring on Friday, they expire on Monday or on Wednesday. So as of today, I have a new choice in which contract I sell. If we were talking about buying, we could also buy these, but yeah, we can actually sell a contract that expires next Monday, which means it's done before that Wednesday announcement. So these are, is there anything else that we need to keep in mind about these contracts? Sort of. Are they really unique beyond that expiration? Not really, not really. But I will say this. So they've been introduced, I've said 9 different equities offer these. It's the MAG 7. If you'd like me to rattle those off, I actually wrote it down because I sometimes commit it to memory and I forget or start to try to rattle it off. Doesn't work very well. So it's Nvidia, Tesla, Apple, Microsoft, Google, Meta, Amazon, and then the other 2 securities are IBIT and Broadcom, AVGO. But Google happens to be, Alphabet happens to be among the MAG 7 stocks that have this new type of contract, this new expiration. But the other point that I wanted to make about these, and it's the one that Eric is asking about, yeah, they're still American style, Wiley. They expire at the end of the trading session. It's not like an AM settled contract. They can be assigned early when selling, just like normal. But they expire at the end of the trading session on Monday. All right. But Eric asked a really good question. He says, liquidity with a question mark? That is a question mark. When something has only been trading for a day and hardly anybody knows about it in the grand scheme of things. In the options universe, there are probably plenty of people that know, but this has had very little time, literally only a matter of hours, to attract an audience of traders. So there might not be a lot of heavy trading on these yet. There may not be a lot of great liquidity yet. And so one way to check that is to see what the spread is between the bid price and the ask price and see if that looks like that's okay. Dragon Rider, your head is spinning? I hope it's not spinning too much because basically these are just normal contracts that happen to expire on a Monday or a Wednesday. Sort of the end. They're weeklies, which is just another name for a normal contract that expires on some expiration cycle other than the 3rd Friday of the month, which was tradition for a long time. So let's go to the trade tab. And here's what I might consider. Let's say we're looking to buy the stock right now. Maybe our trader just looks like they think that Alphabet's likely to continue higher. They're okay with owning shares through the earnings, but they don't want to cap on that, on their potential during the earnings event. I wonder if we were to sell, I don't know, 345, how high could we go? Let's go over here to the trade tab and have a look at these new contracts. So as we look here, there's the 30th of January. Right now it's the 26th. So these are the traditional Friday contracts. They expire in 4 days because today's Monday. So these are Friday. 7 days from now is next Monday. So that's on the 2nd. Our earnings announcement is on the 4th. So let's open those up. And as we look down here through our strike chain, if we buy the shares right now, it might be in the neighborhood of 334. Let's look at, we could sell a contract that's right at the money, 335. That's about a $5 contract. 340, 345 is trading for about $1.70. Here's something that kind of stands out to me. So CBA 82 says better liquidity February 2nd. It's actually not, this is just an impression from one trader. So take it for what it's worth. But when I see literally penny increments here, there's about a 17-cent spread on that $1.87 contract. That's under 10%. There's about a 15-cent spread on this 3.25 contract. That's under 5%. There's a 20-cent spread on this 530 contract. That's under 4%. So these are fairly liquid already, at least using that as a gauge. What would happen if there was really poor liquidity? On illiquid contracts, there tends to be quite wide spreads between the bid price and the ask price, typically beyond 10%. So which one should we sell? Well, we could sell the contract right here. So here's today. And let's carry these out to the 2nd. We're literally only talking about that 1 week. That's how long of a period we're considering getting into a contract. We could do the 340 for a little lower premium, but a little more upside wiggle room. We could maybe do the 345 about here. What do we think? John says, can the exchanges do something to provide the liquidity? So John, it's a good question. There actually is. So there's an entity known as a market maker. Yeah, whose job it is to line up buyers with sellers. Sometimes their job is very easy because there are lots of buyers and sellers and just sort of pairing them all up. Other times the job is pretty hard because maybe there's very few people trading. So when somebody wants to buy, there's nobody to sell to. When somebody wants to sell, there's nobody to have on the other end to buy that contract. So the market maker's job is to step in to nudge that liquidity. And they do that by moving prices up to attract sellers, moving prices down to attract buyers, hopefully adding to that liquidity. And sometimes the market maker has to step in and be the other party in the transaction. If there's poor liquidity, though, what they'll tend to do is just spread the width between the bid price and the ask price apart, essentially to compensate themselves for the risk that they might be taking in stepping into the role of one party or the other. So that's why for some traders they look for a narrow spread. It's an indication of stronger liquidity. But in this case, the liquidity looks comparatively strong. I would say somewhat surprisingly strong for something that has never traded before just a few hours ago. So which one should we sell? Should we go with a closer strike and get a bigger premium? Should we go with a more distant strike and get the smaller premium? What do you think? Let's look at those again. So 340 is around $3 that might be collected. Look at the spread narrowing up. There is probably liquidity entering these contracts as we speak, as the word is spreading. What do we think? How about for this one? Let's do the 340. That's going to be right around 1%. There are some traders who like to maybe get it around 1% for their contracts. But again, this is 1% for 7 days. It's not 1% for like a month or something like that. So let's go ahead and we don't own the shares on Alphabet. So we're going to buy the shares and sell the contract. Buy the shares for around $3.34, accept a contract for around $3 where we agree to sell those shares for $3.40. So there's about $6 of upside potential to the stock position, plus about $3 of income potential from the option that we're selling. So we can go to the bid price, the ask price, doesn't matter which. We're just going to right click and we're going to put in a buy order for a covered stock. Dennis says, what do the letters after the bid ask mean? So that's a little code to tell us which exchange is providing the quote. There used to be an advantage to knowing that. Maybe we could get the best price from if one exchange was offering a better price than the other, but thinkorswim automatically tries to get the best price regardless of exchange. Anyway, Mark says, if open interest is zero, isn't this supposed liquidity just an illusion? Not entirely, because there's the market maker behind the operations here. And if they are offering narrow spreads on the bid or the ask, that would be, and my interpretation would be, take it for what it's worth again, is that market maker feels relatively confident. If they have to take, if we're selling a call and no one else is there to pick it up, market maker has to buy it. They are now a participant in whatever the liquidity of that market is. And so if they think it's an illiquid market, they may want to widen that spread and actually give them a little bit more wiggle room in that position. Anyway, yeah, narrow spread is a pretty good indication of either actual liquidity or a perception of liquidity from an important participant in this. Anyway, I hope that made sense. I know that was a little bit high level. Anyway, let's just do 100 shares. Let's dial this down. Just do the 100 shares. We're going to sell the one contract, the brand new Monday contracts. This will be interesting. By next Monday, we'll be talking about these things expiring in a matter of hours. We're not going to get assigned early. It doesn't happen in paper money. It certainly can happen in real money. All right. Looks like the net debit for this would be around $331 maybe. let's say that we're willing to pay the full natural price, net, to buy the shares and sell the contract. I'm going to lock that in at 330.91 or 90. It's not a guarantee that we'll get this filled. Let's put in this order to buy these new weekly contracts for the 2nd of February. And that would be about $33,000 that we're committing to this trade. There is a commission on that option trade if it fills. And let's send that order off. There we go. So bought the shares. What do we fill that for? We need to go to filled orders. That's where we can find that. Bought the shares for $333.87. We collected $305 on that contract. So there's our net debit. All right. So we'll see where things go from now. If we go up above 340, this trade could be over even before that earnings announcement. If we stay below, well, then very likely the contract just expires worthless and we retain ownership of those shares. Guys, we've accomplished what I set out to do today. There was this new type of option, still very rare. There are thousands and thousands of optionable securities out there, only 9 of which now offer Monday, Wednesday expiration contracts. So I thought that was pretty cool to talk about that today. You know, when something's brand new to the markets, it makes for an exciting discussion. So I hope this was helpful for you. This is what we do with these Monday webcasts. We talk about trading covered calls and short puts, and today we just got to take kind of a unique angle on it. So I hope I'll see you again next Monday. We'll follow up on this trade and on our other existing positions. We didn't really look at the markets today. That's okay. The S&P basically trading, well, I'll take a glance at it. Why not? Anyway, there we go, right up near all-time highs. So for bullish strategies like covered calls and short puts, it's been a pretty forgiving market for going on 9 months now, 10 months now. So we'll see if that can continue for another week. But thanks for giving me your time today. I'm going to let you go, but as I do, be aware of the full slate of resources that you have available to you from Schwab Education, starting with our YouTube channel. If you're new to this and you haven't subscribed to our YouTube channel yet, make sure you do that before you sign off. So you can go down below the stream right now and just click on subscribe. It only takes a second. It doesn't cost anything. But our YouTube channel called Trader Talks Schwab Coaching Webcasts is where you can join these live streams. You can also find playlists of previous webcasts. So you can find my entire webcast series. Just go to playlists and scroll down a bit, and you're looking for covered calls and short puts, right? Now I think it's down here toward the bottom. There it is, right there, covered calls and short puts. You can just click on View Full Playlist, and you can find last week's discussion, the week before, and so on. So if you're wondering where these other trades that we've done came from, that's where they came from. Now, another thing that I would suggest you do, Barb would suggest you do it as well, is to follow us on social media. You can find Barb and me on X. So you can find Barb there at Barb Armstrong CS. You can find me on X at Cameron May CS. So make sure that you are very precise. It's at Cameron May CS, but you just give me a follow here. And I'm very active here, so is Barb. And if you reply to one of my posts, I try to reply right back to you as well. For example, I have a poll going on right now, 20 hours left in this poll. Are your retirement accounts on pace with where you think they need to be? That's an interesting question. Looks like about 44% of my followers at this point are feeling fairly confident about that, but go and click on the poll, and if you leave a comment, I try to reply right back to those comments as well. Now, another thing that you can do as of just a couple of months ago is you can follow me on LinkedIn. So on LinkedIn, you just go to linkedin.com. Let me go right here, refresh that URL so you can see it. linkedin.com/in and then /Cameron May CS. So it's the same handle on LinkedIn, Cameron May CS. Just 197 followers here, so we're still building that audience there. But you can also reply to my posts here, and if you give me a reply, I reply right back to you, and that allows it for interaction in between these live streams. Now, This is your final reminder. There is a survey for those in the live stream audience in the chats. If you click on that survey link, it's just 2 questions, a comments box and a suggestion box. If you fill those surveys out, it's definitely appreciated. It's definitely helpful. They send that stuff right to me and I read through that and it helps out. So thanks for doing that. Finally, guys, thanks for all the likes, the thumbs up on YouTube. It's like giving your presenter applause, but it also gives my webcast a nice boost in the YouTube algorithm. Every time somebody clicks the like button, it sends the signal to YouTube that this is a good webcast. Maybe other people ought to watch it, and it helps more people find it. Everybody, thanks for doing that. I will see you in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.